be pushed down by factors pertaining to liquidity in the Treasury and the TIPS market and other issues pertaining to risk premia. But we have taken note of that, and I would say that that's something that has caught our attention and is a factor that we're watching. So we'd like to have a little bit more confidence, but I would not interpret developments during the intermeeting period as significantly undermining confidence. And the labor market is really important, that as it continues to improve, it has, and we want to see it improve further. That serves to bolster confidence.
Can I ask a second question?
Oh, I'm sorry. You asked about the September 2012 leak. We are working very closely with House Financial Services Committee that's requested information to satisfy their request. We're working very closely with them.
Okay, Benya, and then Alon.
Benya Applebaum, The New York Times. The economic projections that you all released today show that committee members expect roughly a 3-year period in which the unemployment rate will be at its lowest sustainable level, and yet inflation will not rise above 2%. That seems extraordinary. Could you talk about why, as a moment ago you said we would expect inflationary pressures when unemployment is at a low level? Why is inflation going to be so weak for so long under those circumstances? And does it indicate, when you are projecting that basically much of a decade will have passed without the Fed reaching its inflation target, does it indicate that you have failed to do enough to revive this economy in recent years?
Well, we've been very focused, Benya, on doing everything we can to revive this economy and to achieve our maximum employment objective. And after we took the funds rate down to zero, as you know, we put in place a number of other extraordinary measures, including forward guidance and large-scale asset purchases in order to speed the recovery and attain both our inflation objective and our maximum employment objective. And, I mean, when you look at the projection, you see, as you mentioned, that we see sufficient growth to push the unemployment rate. It's already very close to participants' estimates of its longer-run normal level. We expect the unemployment rate to fall slightly, or at least participants project that it will fall slightly below that level. As that occurs, we would expect labor force participation, the cyclical component of that, to diminish over time, and we would hope to see some decline in the portion of slack that's reflected in high levels of part-time involuntary employment. Now, inflation is going back in our projection to 2%. It takes to 2018 to get there. It's awfully close in 2017, and it's not terribly far away even next year. We have very large drags from import prices and energy prices. And over the next year or so, those things should dissipate, and the behavior of inflation should mainly, if our understanding of the inflationary process is correct, and if inflation expectations are well anchored at 2, which I believe they are, as the labor market heals and as that healing progresses, we will see further upward pressure on inflation. That's what we expect. Now, it's a slow process. It's characterized by lags, and that's why it takes a few years as the unemployment rate falls and even overshoots its longer-run normal level. It just takes some time for inflation to get back to 2%. But the overshooting helps it get back faster than it otherwise would. And it's certainly important for us, and I think our credibility hinges on defending our inflation target, not only from threats that it rises above, but also that we not have that over the medium term, that we want to see inflation get back to 2%. And we believe the policies we're following are designed to accomplish that, and will do so.
Elon and then Gina.
Hi, thanks, Elon from the Washington Post. I want to kind of piggyback on Benya's question a little bit and bring up the old thresholds of 6.5% unemployment and 2.5% inflation as the period during which the Fed promised to keep interest rates low. That had sort of assumed, I guess, sort of suggested that the Fed was comfortable with inflation rising above 2%. But you just said moments ago that you don't want to wait until inflation actually hits your target before you are ready to lift off. So I wonder if you could explain that a little bit. Is there a shift in how much inflation the Fed is actually willing to accept?
So let me be clear. 2% is our objective. We want to see inflation go back to 2%. 2% is not a ceiling on inflation. So we're not trying to push the inflation rate above 2. It's always our objective to get back to 2. But 2% is not a ceiling. And if it were a ceiling, you would have to be conducting a policy that on average would hold the inflation rate below 2%. That is not our policy. We want to see the inflation rate get back to 2%. As rapidly as we can. But there are lags in the impact of monetary policy on the economy. And if we waited until inflation is back to 2, and that would probably mean that unemployment had declined well below our estimates of the natural rate, and only then did we start to begin to, and the word tighten monetary policy I don't think is really right, because we have an immensely accommodative monetary policy in place. So let me say, just to begin to diminish the extraordinary degree of accommodation for monetary policy, we would we would likely overshoot substantially our 2% objective. And we might be faced with then having to tighten policy in a way that could be disruptive to the real economy. And I don't think that's a desirable way to conduct policy.
Gina and then Peter.
Gina Smilik, Bloomberg News. You mentioned earlier that, there is always going to be some uncertainty in the global economy. Yet it seems that uncertainties are what kept you from hiking this month. How do you communicate to markets what is the kind of uncertainty that keeps you from lifting rates, and what is the kind of uncertainty that you can overlook and, move in spite of?
So that's a very hard question. And, it's why we come together and have very careful evaluations of a wide range of factors. But at the end of the day, what we're focused on are two things: the path for employment and whether or not we feel confident that we're on a road that will take us to our maximum employment objective, and whether or not we see the risks around attaining that as balanced. Of course, there will be uncertainty around it. And whether or not we have reasonable confidence that inflation will, over the medium term, go back to 2%. And it's really through that filter that we're trying to look at uncertainty. Of course, there are many uncertainties in the global economy, but we're asking ourselves how economic and financial developments in the global economy affect the risk to our outlook for our two goals, and whether or not they create unbalanced risks that we want to wait to resolve to some extent.
Okay, Peter and then Ann.
Chair Yellen, Peter Barnes of Fox Business. Could you talk about a little bit more specifically about what foreign developments you discussed in the meeting today, what you're concerned about? We all assume it might be China. That was in the July minutes. Are you concerned about the Chinese economy slowing, the markets there? Do you have any concerns about the European economy? And then related to stock markets, could I ask you how you feel about U.S. equity markets right now? Because you did talk about your concerns about them back in May. You saw they were generally quite high and were worried about potential dangers in U.S. equity market valuations. But now equity prices have pulled back. Thank you.
So with respect to global developments, we reviewed developments in all important areas of the world, but we're focused particularly on China and emerging markets. Now, we've long expected, as most analysts have, to see some slowing in Chinese growth over time as they rebalance their economy. And they've planned that, and I think there are no surprises there. The question is whether or not there might be a risk of a more abrupt slowdown than most analysts expect. And I think developments that we saw in financial markets in August in part reflected concerns that there was downside risk to Chinese economic performance and perhaps concerns about the deftness with which policymakers were addressing those concerns. In addition, we saw a very substantial downward pressure on oil prices in commodity markets, and those developments have had a significant impact on many emerging market economies that are important producers of commodities, as well as more advanced countries, including Canada, which is an important trading partner of ours, that has been negatively affected by declining commodity prices, declining energy prices. Now, there are a lot of countries that are net importers of energy that are positively affected by those developments, but emerging markets, important emerging markets, have been negatively affected by those developments. And we've seen in significant outflows of capital from those countries, pressures on their exchange rates, and concerns about their performance going forward. So a lot of our focus has been on risks around China, but not just China, emerging markets more generally, and how they may spill over to the United States. In terms of thinking about financial developments and our reaction to them, I think a lot of the financial developments were really, so we don't want to respond to market turbulence. The Fed should not be responding to the ups and downs of the markets, and it is certainly not our policy to do so. But when there are significant financial developments, it's incumbent on us to ask ourselves what is causing them. And, of course, while we can't know for sure, it seemed to us as though concerns about the global economic outlook were drivers of those financial developments. And so they've concerned us in part because they take us to the global outlook and how that will affect us. And to some extent, look, we have seen a tightening of financial conditions during, as I mentioned, during the intermeeting period. So the stock market adjustment combined with a somewhat stronger dollar and higher risk spreads does represent some tightening of financial conditions. Now, in and of itself, it's not the end of story in terms of our policy, because we have to put a lot of different pieces together. We are looking at, as I emphasized, a U.S. economy that has been performing well and impressing us by the pace at which it's creating jobs and the strength of domestic demand. So we have that. We have some concerns about negative impacts from global developments and some tightening of financial conditions. We're trying to put all of that together in a picture. I think, importantly, we say in our statement that in spite of all of this, we continue to view the risks to economic activity in labor markets as balanced. So it's a lot of different pieces, different cross currents, some strengthening the outlook, some creating concerns, but overall, no significant change in the economic outlook.
Ann Saphir with Reuters.